Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for January 29th, 2017. Market is in bullish, quiet conditions. I should say your report may say January 22nd. I forgot to update that as of date. It should read January 29th. You can check that by looking for these dates on the market mosaic. Sorry about that. Looking at the annual posture, we are in the high end of neutral at 69 out of 100. The threshold to overbought is 70, so we're getting very close to that condition. On a 10-day basis, using the 10-day NDX, our trade location is overbought at 83 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is green bullish, 7.10%. So we're 5% above the sideways threshold. The slope of the 50 is improved to green bullish. ADX is a neutral, non-trending 18.2. ATR percentage extremely quiet at 0.59%. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the threshold between risk on and risk off. The current reading is at 1.028, so we are in risk on, favoring riskier assets. We take that score and compare it to the last 5,000 trading days and compute the risk z-score. We're at 0.22 standard deviations above the long-term average. You can see a 90-day histogram of that indicator here. When it's above the zero line, we are in risk on. But you can see we've come from this long period of the Trump bump where we had some positive benefits. But very quiet out there right now, and the market is fragile, but we still have a long side bias. We will be adjusting the blended monthly rebalancing portfolios next week on or about 1 February. These are the current holdings. They're looking pretty good. These are the leading candidates based on closing prices on Friday for the various populations. Notice the strength in financials: Goldman Sachs, J.P. Morgan, American Express. KRE and KBE are both regional banking ETFs. So there's certainly financials have been benefiting from this Trump bump. All of the blended monthly rebalancing portfolio for ETF 13 and most of it for 32 are all on buy signals. You see at the top are all U.S. all the time, small caps, mid caps, diamonds, tech in the U.S., followed by the internationals. Only treasuries are on a cash signal. And in the ETF 32, financials, emerging Europe, and industrials all accelerating to the top here. So again, this is basic producers, and then the finance sectors are benefiting from a Trump month, if you will. In ETF Max, you can see a lot of benefits are extending into the financial sectors, basic materials. Copper is is a leading indicator of economic activity in industries, so that bodes well for long term. Our leaders have been having a really good week so far this past week. This is that same logic looking at the S&P 500, technology in the form of NVIDIA and Micron and Western Digital at the top, but you also see some basic commodities like Alcoa, Freeport Moran, CF Industrial Holdings. Looking for some interest here in United Rentals, and then more at a CSX in the transports. So all America all the time. In the market health check, we've had this long sideways choppy period, I think, while people are adjusting themselves to a Trump reality. The Trump enthusiasm can be seen in the initial sell-off just prior to the election, and then the Trump bump of 10%, where it's gone from 208 to 228. but the last 30 days have been sideways chop. One test to the downside that was immediately corrected, chop, and now we've had the breakout at the end of last week. And this could be a breakout from the base, and we are conceivably looking at another bump of this magnitude here. Failures, though, out of the bottom of the channel would target initially for 224, then down to 219, and then 214 near the 200-day moving average. But the slope of the river is up, and the last breakout was up, and even the sell-off of Thursday and Friday was orderly. Cautiously optimistic. But the world can change pretty fast under the Donald. Looking at the ETF regional report, all of the regions are on a buy signal, so we're at 100% compared to 100% invested, 0% cash. U.S. Is better than the globals. We're now at 50 rather than 46. Inside the U.S., it's small caps, mid caps, large caps, tech. It's been that way since the start of the year. The two strongest sectors in the world right now, U.S. small and mid caps. Enthusiasm returning to the U.S. And the two weakest, Latin America and emerging markets. Inside the S&P spiders, financials and industrials and materials. Consumer staples and utilities suffering. I'm curious to see how the healthcare is going to unwind. I think the concerns about a Hillary presidency it caused a suppression in XLV. And now the return of the Trumpinator, however. Should be interesting to see if healthcare is prepared to make a rebound here in the next quarter. World market model, small caps, and then value plays doing well in the U.S., which is above average or exceptionally above average. Underperforming here in the alternates, gold, silver, treasuries, bonds. Asia suffering except for Australia. And Europe lagging as well. Canada really the only other country besides Australia that's joining the party. In Europe it's Austria, Germany, and Sweden. The financial strength is part of that international cabal. Also benefiting from Trump. Seeing the same logic here in the ETF 30 using that lens. Metals and mining, regional banks, bank portfolios, Russia and her oil, more financials and oil services, oil and gas exploration, perhaps reflecting some strength in U.S. exploration. We'll see. U.S. financial sector. Just notice XLF, the sector spider, very strong now. Among the Dow 30, many more now in the green, and so the long-term winners are those that are both strength and consistency have been excellent. Morgan, Goldman Sachs, Boeing, Caterpillar, and American Express at the bottom. Walmart, Pfizer, Johnson & Johnson, Coke, and Verizon. So J&J and Pfizer, I'll be watching these things as deep discount opportunities, certainly. Looking for turnaround plays. Chevron starting to lose some steam. It's white and green, whereas IBM is green and then white, strength and consistency. So that's evidence of early in the business cycle. So Goldman Sachs also should be of interest. The most liquid ETFs on the basis of their average 30-day average daily dollar volume. The Russell still dominating over tech in terms of the daily trade. Miners have had some interest, as has Brazil, continues to be liquid and volatile, as well as the VIX. Shifting to the daily, only a handful, a couple really, of channelings and triple screens and 551Ws. You can see some good auto framer stats in here, and then 4 or 5 on the frog quality numbers. Had quite a few dojis on Friday, And then here's Chevron, which was a percent loser, down 2.4%. His RSI 2 is 10, so that's good for short-term trading. Maybe oversold. And then 2.1 auto framer reward to risk. It's a max pain candidate and was both channeling and overreaction. So let's see what that looks like on a chart. All right, so here's a look at Chevron on a daily chart. And you can see that we've been tracking and trading this one as a swing from the end of November when it broke out of a sideways quiet channel. We had our stop below the at Z1, and we've enjoyed the move up to a peak almost to Z3, and the sideways chop, and then our exit when we had the RLXD up in here in the second week of January. It's really done nothing but sideways chop. And notice the compression of the Z3 channel here. But Friday's price action, a breakdown, and then a strong bounce during the day. But that's a system shock. The fact that it was able to close higher than the low makes it interesting. This is a Z3 condition, so I am discounting that previous strong move, and I'll be looking to trade this only short term at first in two ways. One, if I get a entry higher than 114.50, which is the Z1, the Z2 line, then I'm going to trade this with a stop down here at Z3, and I'll trade this as a return to the Bollinger Band mean up around 117. So that's a 2-to-1 reward to risk ratio. But if we should see any kind of failure, then the fact that we've had the owl pattern rolling over and then a shock to the downside makes this attractive initially as a short. And what we'd be looking at is, I think, back to about here. Yeah, I would say right about here, that 109 or 110, the initial downside, followed by 106. So Chevron is certainly in play. That's going to be an interesting ride tomorrow. And so while this is a swing trade as a channel and an overreaction, it also sets up very interesting intraday possibilities too. So let's just dial down to 2 hours and see what we can see. And you can see there was the open, the initial sell-off, a strong rebound, and then a decay the rest of the day, which still closed higher than the opening, but that feels like it's fairly priced as the market digests that news. Drilling down further to the 30-minute. Reaction against news, a rebound as an opportunity, but then nothing. That's the least expected result when you have that much of a sell-off and that much interest in the rebound. That is the least expected. Down here at the 3 minutes, you can see that there was a morning hook opportunity, but really nothing the rest of the day. This pinch, the Z3 pinch right here, might have got a short, probably for a scratch inside here. But certainly the P7 trade here is was certainly available on Friday. And you can see the VWAP trade here at the end of the day as you get an extension down to Z3, and then a return to the VWAP when interplay as a 1, 2, 3 entry right about in here, or an RLXD when it comes through the dragon with a target up here. Just to mention that in passing. This is the reason why we like that Z3 pinch. You do get an orderly move here of $1.50 intraday, coming out of that sideways quiet channel. So I think Chevron's in play tomorrow. And let's get back to our regularly scheduled program. All right, we're going to notice that Verizon is number one on our auto framer and max pain range compression list. It's down over 10 days and 1 month by an exceptional amount. So let's take a quick look at Verizon, just see what we can see. Here's a quick look. Notice how trending it is on daily charts in terms of swings. That's what makes Verizon a really attractive candidate for swings. And so when we zoom in a little closer, this is a perfect setup for a 1, 2, 3 entry and a Z3 and an entering at Z2. So I would enter here at 49.85 tomorrow. Stop below the swing low. There's my trade frame. So I'd like to see an orderly entry inside this yellow zone of the of Friday's price, and I would take a continuation as a 1, 2, 3, and then a entering at Z minus 2 with a stop at Z minus 3, and a target initial target of Z minus 1, and then Z0, and then the far side. So you can see that a return to the Bollinger Band mean is just a return to the previous fair value, which seems to have bottomed out here. And then this red line would be a failure, automatic stop and reverse, should that happen. And again, we'd be looking at I think a target on a failure down here at the Bollinger Band, or at the Dragon Belly, down here around 47. So if we get short here, we'd be targeting here, and then if it failed below this previous swing low, then that's where you would want to add another position short. There we go. And we'd be looking to add a second position down in here. So let's make this one a purple target. So that would be a short initial target, preserve profits, but then if it breaks down below this swing low, it's the cut below, and then the first trade will be deeply in the money, and then looking for, well, that would really be bad news for Verizon, because then the next place we see is down here around 43. Down around in here, 43 and a quarter, or 3/4. So plenty of room for Verizon to fail, but also room for it to get all the way back up to 55. So an ideal candidate to be stalking for swing trading in the days and weeks ahead. Okay, let's get back to the daily. Looking at the Dow tactical there, and now back to the ETF tactical. Really no patterns other than a handful of 551Ws in healthcare treasuries and gold. The VIX was a big loser and has been over the last every time period, and is at 5-1 in the auto framer right now. XLV, the healthcare, is of interest. Based on my earlier. Here's XLV over the last a little over, I guess, a year. They worry about a Clinton presidency, I think, a Trump bounce in here, but then a pullback. So this pullback to support level at the bottom of the river is interesting. Now, what makes this attractive is the fact that we've got a low, a higher low, a higher low, and now we're testing that low. If this holds, then we're looking back to the RL270. If this fails, then we're looking to get back to 68 and then 66. And a failure here would be seen as a head and shoulders failure, but a rebound would be an upward trending swing. So I like how trending this move has been, and the fact that it's holding steady support in here, in my view, is favorable on the long term. So healthcare, I'm starting to like. Nothing in the auto framers. The RL, the regression line fractals, you can see in the Dow 30, the big winners. In the red, these are the relative strength leaders, and in the green, these are the ones that are the most ATRs below their RL270. And so these are the ones that are deep value. These are the relative strength leaders. Johnson & Johnson and Pfizer look attractive to me. We've already seen Verizon. The slope of the RL30 got to an extreme Z plus 2 during the initial Trump bounce. It's pulled back into an orderly level right now based on this stability of the last 30 days or so and this tiny little bump. So this really is a nice base of support upon which to build further, and that's why I wouldn't be surprised to see another 5% leg up here in the short run. I'll just scale through these here real quick for your reference. Microsoft standing out on the Z-score of performance. Latin America actually showing a little strength in here also. The Z-scores of the regression line slopes. The 90 has now pulled out of the normal channel. The 30 has found support and is bouncing. And the higher lows in the 10 looks to me to bode well. The only concern I have is that it's hard for the 90-day to get much stronger than this, and it's already starting to roll over. The last time it did that, there was some downward pressure, and then when it rolled over here, there was some downward pressure as well. On the positive note, this favorable base of action here, supporting this breakout, and then a potential move of this magnitude. That's what I'm thinking. Another 5 to 10% is not out of the ordinary. Were this to fail, though, then it comes back here to around 215, as we've seen. Okay, so that's everything I want to cover now. The world is watching with stunned silence and outrage at the new presidential and political new order. And that's going to favor short-term traders who can manage volatility in both directions, but who can also find deeply discounted value in basic economic engines. And I think it's we should be looking at the U.S. More so, because any policies are going to be directed towards favoring those companies, and that's where I think domestic money is going to go. So this is Ken Long from Tortoise Capital. Keep your risk measured and powder dry.